Today I wanted to talk about margin calls because I just read in the paper that Michael Pearson, the CEO of Valeant, had Goldman Sachs call his margin loan on Thursday. So what happened is last year Michael Pearson borrowed $100 million from Goldman Sachs, probably at between 1 and 2% interest rate. Super attractive loan, probably tax deductible, almost assuredly tax deductible knowing this guy. And then Valeant stock dropped. In the past month, it's gone from 175 down to now like 80. And with that drop, he got a margin call from Goldman. So they wrote to him on Friday and said, hey, you need to repay this $100 million by Tuesday. And Tuesday passed and wasn't repaid. So Goldman, which has the brokerage account in its custody, sold 1.3 million shares on Thursday. That contributed to the stock's decline of 14% on that day. And now those 1.3 million shares are gone. And Michael Pearson, who used to have $200 million worth in stock, now has had those $200 million plus sold without his control because he took this margin loan. And this is fascinating. Margin loans are a concept that I find very, very interesting, and that's why I wanted to talk about it today, because it brings out weird behavior. You have this thing which looks like the perfect loan. You don't have to repay it until you choose to repay it. It's very cheap. It's generally tax deductible. And by very cheap, I mean 1 or 2% right now. So it's basically free money. It's like somebody comes to your house, gives you a briefcase full of money, and says, you can have this until you choose to repay it. Which is great, and the collateral on it might even go up in value. So it's like totally free. A lot of CEOs have margin loans. I'm sure they've been sold it by Goldman Sachs and their other wealth management providers. And a lot of individual investors also use margin loans, certainly hedge funds and everybody else, because it looks like this perfect thing. The problem is that your collateral is the value of the stock. And when that collateral declines, your broker, who's making between 1 and 2% on this margin loan of yours, they're not gonna be nice about it. They're gonna say, hey, I'm gonna lose all this money, and on the upside, I might make 1 to 2%. No, they're not even gonna call you. You're not gonna get the Michael Pearson, reprieve of 4 business days. They're gonna take you out. They're gonna treat you like you have a Ford Tempo that you haven't paid for, and they're gonna shut down the car remotely. Then they're gonna send a tow truck out, and they're going to drive it away. That's what they're going to do to your stock. They're just going to blow it out. So Michael Pearson is not the only CEO who has margin loans. He's certainly not the only investor who has margin loans. And for anybody out there who's considering or who has a margin loan, this is a wake-up call that maybe you want to cut down on how much you are borrowing, because this stuff, when it goes bad, goes very bad, very fast. And in general, so that's one aspect. Other people should be using this as a wake-up call. And the other aspect is that a lot of debt works the same way. It looks great. It's very cheap right now. Everybody's been able to get it. And when it goes bad, it causes people to do things that no rational person would want to do. Nobody wants to sell on a day when the stock is way down. But that is exactly what a margin call forces you to do. You don't even have the choice. They do it for you. But the same thing happens if you've borrowed a lot of money to, drill oil wells, or you borrowed a lot of money on the value of your oil producing assets to, say you're Venezuela, to make bread cheap or something like that, to make apartments cheap, to enrich your people, at least your corrupt classes, by setting a very weird foreign exchange rate. In any case, when the price of oil or whatever it is that you basically are borrowing against declines, you are forced to do crazy stuff. You're forced to sell assets and products at rates and prices that are way lower than any rational person would do it. And your forced selling pushes down the market price, which can lead to other people doing crazy stuff. So, A, wake-up call. B, this could have knock-on effects for other investors, and this can lead to a puke out where people are selling assets in high volume at prices that nobody would rationally expect or reasonably expect anybody to be willing to sell us at. But that's what happens in a puke out, either because of weak emotions, which just happens, we're human, or you're forced, regardless of how strong your character is, because of leverage, because of debt that must be repaid regardless of circumstance. So those are the things, and the way to try to avoid this is really to look at the downside. I am increasingly impressed with the power of this framework of look at the downside, because many times you have an opportunity that seems risky, but if you really look at the downside of what will happen if it goes very badly, it's not so bad. Should you take that job in the other place? Should you try to change your career? Maybe the downside is actually very low. Or you have cases where, should I take this, briefcase full of money at no cost? Well, if you look at the downside, sometimes that means that you get blown out like Michael Pearson at the worst possible time, and you don't get that money back. It doesn't matter if Valeant stock doubles or goes back up to 175 next month. His shares are gone. He's like the statistician in the joke who drowned in a river that's only 3 feet deep. You get caught at the bottom, not at you don't survive the valley of death. That's where you die. Everybody else is fine. So again, look at the downside in evaluating what you're going to do. Sometimes it will make you do things that seem risky, and sometimes it will make you avoid things that seem perfectly safe, because there is that downside. And the last little thing that I think is interesting about this case is it is a demonstration of what happens to winners, because when two equally matched contestants come together, one wins and their testosterone shoots up, and the loser's testosterone shoots down, and then that winner is actually quite a bit more aggressive and more willing to fight, and makes them more likely to win their next encounter. And then they carry this forward again and again and again, until you get the case where the winner has won so many times that they are convinced and so full of testosterone and belief in their own power that they're convinced that they cannot lose, and they take risks that you or I think are ridiculous. And they come out into the open thinking that they are invulnerable, and that's where they die. And that is, I believe, what happened to Michael Pearson, and that is the risk of winning. So in this one little tale of Michael Pearson and his Valeant stock, we have a lot of interesting things. So beware of winning too much. It can make you crazy and vulnerable to just horrendous losses. Look at the downside, and really don't use margin debt, and be aware of what can happen when other people in your area are leveraged, or in any area are leveraged, because they might be forced to do stuff that no reasonable, rational person would do. So that's us talking about margin debt today, and the broader thoughts around it. If you like this video, like it, subscribe, and we'll talk about some more stuff in the future. Thanks so much, guys. Bye-bye.